Welcome to Real Economy. We're in Frankfurt, the home of the European Central Bank, better known as the ECB, to talk about central banks and their often cited monetary policies and how they impact not just our economies, but your life and mine. On the Real Economy hot seat, Jean Claude Trichet, the former ECB president, talks to us about decisions taken by the central bank through the crisis. We then analyze and break down monetary policy across Europe with the ECB's first ever chief economist, Ottmar Issing, and London Business School economics professor, Richard Porteous. Price stability, the mandate of the ECB and a focus of all central banks, is to ensure that your money and mine retains its value over time. Falling prices or deflation is one end of that battle, but inflation has been the focus of this crisis, as has been keeping it under 2%. So what is inflation? Here's a quick crash course.
Inflation is the rate of increase in prices over a certain time. If you spend €100 in a year buying things like food, a haircut, a computer or petrol, all these things together create the Consumer Price Index, or CPI. If the same things cost €102 the next year, consumer price inflation would be 2%. Take out things like food or petrol from CPI, which can be affected by the weather, supply problems, or when the government fixes prices, what's left is core inflation. So inflation means you can buy less for €1 than before. So what causes price rises? If everyone suddenly wants a video game and the manufacturers can't make enough, or if there is bad weather or an accident that affects production, prices rise. If there is too much money supply and people have more cash to spend on, say, TVs, but the supply remains the same, then people may be ready to pay a higher price for that TV. Or if interest rates are suddenly cut or the government spends more, then inflation goes up.
So we know inflation impacts our standard of living. A traditional tool used by central banks to stabilize economies are interest rates. Now, through the crisis, we saw those interest rates drop, not just here in Europe, like you can see, but across the world. Then we start using unconventional tools. Here at the ECB, they used LTROs and OMTs. At the Federal Reserve in the US and the Bank of England, they used QE. A lot of acronyms that we will break down for you and see how they've impacted our lives.
Paying at the checkout, we've sometimes wondered, can I afford my shopping? What influences the value of my money? Well, central banks like the ECB monitor the stability of our banks, print our money, decide our interest rates, and act to maintain price stability.
Monetary policy affects us all first through its influence on inflation. We see that every day when we walk into the shops, how fast are prices rising, or not, as the case may be. The second is through the housing market. Monetary policy determines what interest rates we have to pay if we've got a mortgage. It has a major influence on house prices.
In 2007, the US housing crisis pushed the ECB to give unlimited overnight liquidity to Europe's banks, meaning they could ask the ECB for as much money as they wanted to stay safe. The bank then cut interest rates to ensure price stability, but in 2011, despite the Eurozone crisis, the ECB remained focused on fighting inflation and raised interest rates again.
We should never forget that inflation, as well as deflation, hurts the weakest members of society most. Rich investors can protect themselves against inflation and against price increases.
But a collapse of the euro rather than inflation was the financial market's primary concern. In response, the ECB cut rates and conducted 2 rounds of LTRO, or long-term refinancing operations, which are simply cheap loan schemes for European banks to make sure they don't collapse. The idea? They put up collateral backed by their own national central bank. But the markets didn't swallow the solution, so the ECB announced outright monetary transactions, or OMT, a program based on a promise by the ECB to purchase Eurozone countries' bonds.
The ECB can now purchase debt securities of Eurozone countries without any limit on quantity, but to take advantage of this they must accept some restrictive measures, in particular cleaning up their public finances.
The danger? That if OMT has to be paid, Europe's taxpayers will be responsible for unlimited sums of money.
The rosy scenario for me is that the OMT will never be activated. It's a promise, it's a fleeting being. It has calmed markets, and if everything goes well, it will never be activated, I hope.
To kickstart spending and get growth going, both in the US and 3 times in the UK, a different instrument was used, QE, or quantitative easing, totalling £375 billion. The Bank of England bought assets, usually government bonds, from private investors such as pension funds. They did it using money simply created out of thin air, and not by printing more banknotes. Because this money has a low return, the private investors use it to buy things like corporate bonds, putting money back into the economy. But despite all the different policies, bank lending to people like us hasn't really picked up. So what's going to change it?
Make it possible for banks to lend to these firms and then package up those loans into a package that the central bank could take onto its books as collateral for further funding for the bank that has been doing that lending. That is a proposal that seems to me to make a lot of sense, but it's not going to happen tomorrow.
The last 4 of his 8-year term as ECB president saw Jean Claude Trichet face the dark clouds of first the global economic slowdown and then the Eurozone crisis. Always with an eye on inflation, his policies were both admired and critiqued. Well, I caught up with him to talk to him about his decisions and also the ECB's actions today. Mr. Trichet, thank you very much for giving us time and coming on the show. When you think about the OMT in itself, in your opinion, do you think it's just rhetoric, and what happens if we have to actually go and use it?
Well, first of all, it's not rhetoric because the ECB bought treasuries twice when I was president myself. And that one of the reasons why the market trusted that this was for real was that we had done it already. That being said, as always, before and with the OMT, there is a conditionality. The country concerned has to call for being helped.
Comes back to the moral hazard question. What happens if these governments don't play along?
Conditionality has always been part of this exercise. If conditionality is not respected, the ECB shall not and should not ignore it.
The other fundamental question then would come back to what your expectations are.
We are in a universe where the ECB is giving all the liquidity which is necessary to all banks, commercial banks in Europe first. And this is something which can continue as long as necessary. This extraordinary position that the ECB has taken since the beginning of the crisis, but responsible position, preserving the primary mandate, sending the messages, the very strong messages to governments, parliaments, and to, I would say, all the private sector. We might, again, as I already said, expect that progressively the confidence is consolidating and that growth and job creation are coming back. You have the banking union, which has to be done, including the resolution authority at the level of Europe as a whole. We resisted the crisis. That's obvious.
That brings you back to the fact that you were the first central banker to react in August 2007. How would you change the situation to get the growth back in faster and get the credit flowing faster? Would you do anything different?
The messages according to the ECB, where crucially, you have to make your homework immediately because you put yourself in a very dramatic situation individually, countries that were attacked by markets, and collectively because you did not survey what you did. But in my opinion, in the recovery process, in the adjustment process, perhaps we could have insisted more on the fact that in adjusting, one should not privilege the insiders, those who have a job, to the detriment of the outsiders, those who have no job, and the young people and so forth. Because the adjustment is triggering enormous amount of unemployment. And that particular message could have been perhaps sent more, I would say, forcefully. It's an economic message. It has nothing to do with monetary policy, but it is a message which I trust, with the benefit of the hindsight, we see.
Ms. Trichet, my final question to you. Do you think in this new normal we need to find economists, central bankers who think completely out of the box?
Had central banks not sent very strong messages to government that they have to react themselves as boldly and swiftly as possible, we would have had the worst crisis for one full century. And perhaps I could say for 2 centuries, obviously. So we have to be fully aware of that. We thought out of the box massively. What is important is that the permanent message coming from the central banks is we cannot substitute to other partners. What we are doing is necessary, in our opinion, because we have to pave the way for the appropriate transmission of our monetary policy, but do the job. Don't count on us to substitute to your own hard work. It is true for all public authorities. It is true also for all the private sector.
Mr. Trichet, thank you very much for your time in coming on the show.
Thank you. It was a pleasure, madam.
Well, that's a wrap from here in Frankfurt, where winds of change are blowing not just through the city, but the central bank it houses. We'll see you the next time here on Real Economy. Until then, thanks for watching. Goodbye.